Welcome back. In the last couple of lectures, we talked about the idea of valuing NOPAT, but first we had to establish the sustainability of NOPAT. So I said that NOPAT, earnings power, effectively the same measure of cash flow, and the phrase in the industry is earnings power value. I use NOPAT as my base of that, and we talked about that. But I paused for a moment and asked, would a positive NOPAT attract competition? And the reason we cared about that is that we're trying to build up a base level of valuation. Over the next couple of lectures, I'll start to add in the value of growth. That's where we're headed in this lecture series. But first, we had to establish what I often call a base camp or a base level, earnings power value. Earnings power value is effectively a steady state, no growth value. But the assumption behind earnings power value is that NOPAT, our primary measure of cash flow, you can think of it as earnings power, Buffett calls it owner's earnings, is we need that to be fairly stable. We talked a lot about that in the last couple of lectures. And then we addressed this, or raised the issue really, of would that positive NOPAT attract competition? Because if it does attract competition, then perhaps our assumption that it's a steady state, a set of cash flows may be too aggressive. It may not hold. Competition will come in and drive those cash flows lower. And then that would not allow us, we would not be able to use the perpetuity valuation formula to establish that earnings power value. All right, that's what we talked about in two very specific frames or two different approaches in the last two videos. What I want to do now is start to build up how we think about valuation of NOPAT. And we're going to look at those two components, essentially the required rate of return and then excess return. And that will start to build up our sense of how we want to think about competition and particularly competitive advantage when we're valuing companies. And it's only after we've established a good comfort and understanding of that earnings power value that we need to value growth, or that growth would have any value. So we have a couple more lectures where we're really focused on this idea of valuing NOPAT. And so I want to use those insights to build from there, setting ourselves up to start to talk about growth, which we will over the next couple of lectures. So we'll be into lecture 14 or 15 when we actually get to start to talk about growth and valuing growth. All right, as we established over the last two videos, this idea that that's your NOPAT, level of NOPAT, and you can call that earnings power. To me, NOPAT and earnings power are effectively the same thing. I think of earnings power as the idea that a steady state NOPAT, it may not be the most recent NOPAT, but it's a steady state NOPAT that you're comfortable with, can extend well into the future. Steady, no growth. And I like to think of kind of a 10-year horizon. As we get into the growth, deeper into growth, I'll talk a little bit about why I think of a 10-year time horizon for earnings power value and why I use a 25-year DCF. We'll elaborate on all that. But I just want to work a bit more with earnings power value. All right, so we just flip earnings power to the outside, replacing NOPAT, and then duration. In reality, my thinking is 10 years, but in reality, the duration is forever. And I went through that a couple of times in the last two videos of why we should be comfortable with forever, just part of the business. And then the area, earnings power times duration, is your earnings power value, EPV. We're going to use this construct today to take some of the components of earnings power value, NOPAT, apart and see how they impact valuation, how we want to think about valuation. All right. So we established in the investment opportunities, this was investment opportunity 3, hard kombucha, and I showed that you effectively, if you take your capital charge, which was $10 million in every example, you subtract that from your NOPAT, you're left with excess return in dollars. And it's that excess return either in terms of return or dollars that attracts competition. I'm going to use this insight to think about valuation. And I'm going to walk through some equations. They're not very complicated, but I want to build up to what is the beginning of something we colloquially call the Italian cookie valuation model. And we'll start to introduce that. All right. So from this analysis we did, this investment opportunity, looking at the yellow box, we know that excess return in dollars equals NOPAT minus capital charge. Capital charge is the amount of money the company has to make on its investment to justify its cost of capital. That's the capital charge. And so if I take and subtract that from NOPAT, I'm left with those excess returns. In the hard kombucha case, we had 10 million in forecasted NOPAT, 25 million in forecasted NOPAT, and we had a capital charge of 10, which meant that the implied would be that there would be $15 million in excess return in dollars, 25 minus 10. All right, so we established that NOPAT minus your capital charge equals your excess return in dollars. Now I'm introducing two colors here, effectively a red and a blue. And from this point forward, those colors will be consistent in my charts. That's why I want to introduce it. Now, all I'm doing in this case is I'm then moving the equal sign. So now we know that from here, we knew that NOPAT minus capital charge equals excess return in dollars. Well, therefore, NOPAT has to equal capital charge plus the excess return in dollars. So just move the equation. Okay, great. All right, so if I want to know what the value of NOPAT is, which we call earnings power value, I can then go look at its subcomponents. All right, so we established this, the earnings power value, if we believe in a steady state, no growth, perpetuity earnings power, then we can use the perpetuity valuation formula, which is NOPAT divided by the cost of capital. We established that really in the last couple of videos. All right, so then the value of NOPAT would effectively be the value of earnings power, which is earnings power value. And then that's NOPAT times cost of capital, just using that same perpetuity formula. So all I'm doing is linking some pieces from before. All right, now I know that earnings power value is equal to it's got to be equal to the value of the capital charge plus the value of excess returns. And that's because we know that earnings power is equal to capital charge plus excess returns. Then the value of that earnings power value, has to equal the value of capital charge plus the value of excess returns, continuing with my red and blue. All right, so the value of capital charge would be the capital charge divided by the cost of capital, which using the perpetuity formula, we've done that a couple of times. And we can show this in a slightly different math, the value of the capital charge. We know capital charge is equal, it's defined by the cost of capital R times invested capital, which we have abbreviated as IC, the cost of capital times the amount of capital you have invested in the business or the business opportunity. So I just rearrange this equation and I just show you that capital charge divided by the cost of capital equals the invested capital. It's a really important insight that we're going to carry forward. So the value of capital charge is the invested capital. It's a funny way to think about it, but it's going to become a very important tool as we start to look at real evaluations of real companies. All right, so the value of the capital charge, the first part of the equation, equals capital charge divided by the cost of capital, which equals invested capital. Effectively, all we're saying is a company that earns its capital charge is equal to its invested capital, which we established in the prior two videos. So the value of the capital charge, funny way of saying it or thinking about it, equals the invested capital. So the value of the cash flows that cover the capital charge is invested capital. Another way of saying that the value of a company that just earns its cost of capital should be equal to its invested capital and no more. All right. Now, excess returns, the second part of our equation, the value of excess returns in dollars. Now, remember, we have two ways of thinking about the NOPAT, or the excess returns in dollars. NOPAT minus the capital charge, or just excess returns in dollars. If we use the perpetuity formula, we then can value those. So the value of excess returns in dollars is just the excess returns in dollars divided by the cost of capital. Easy to be, right? Now, we assumed in this case that earnings power would stay steady, said that a couple of times, and so earnings power value is based on the idea that NOPAT, earnings power, is going to stay steady into the future. However, if competition enters the market and drives down those profits to a lower profit, then that assumption of a steady state, no growth, NOPAT or earnings power does not hold. So effectively, the value of excess returns in dollars is if we want to use the perpetuity valuation formula, then we must believe that NOPAT will be stable into the future, which assumes that competitors will not be able to enter the market. This is the key insight, right? So that red layer is just your capital charge. The value of any business is equal to the capitalized capital charge, which is invested capital. But that excess return in dollars, if we want to use the perpetuity valuation formula, we have to assume that those excess returns are going to be stable, which effectively means the company has a competitive advantage, right? So one more time, to value excess returns in dollars using the perpetuity valuation formula, we must believe that NOPAT will be stable in the future. That's our base assumption, which assumes that competitors will not be able to enter the market. That assumption, right, that competitors cannot enter the market implies that the company has a sustainable competitive advantage. Therefore, if we capitalize excess returns in dollars, it is the present value of that competitive advantage. And that's the name we're going to use it. So the second layer is going to be the present value of competitive advantage. All right. So now we know that EPV, earnings per value, is equal to invested capital plus the present value of competitive advantage, the present value of those excess returns in dollars. So we're starting to build up our valuation stack. All right. So EPV minus invested capital is the value of competitive advantage. So the present value of competitive advantage. So we can just think of it in two different forms. So now we have two layers. We have the invested capital. That's the capital invested in the business, and it should be worth what it's worth. And then you have, if there are excess returns, the value of those excess returns indicate that the company has a sustainable competitive advantage. So we refer to that as the present value of competitive advantage. All right, let's go look at the three investment opportunities using these new tools. All right, craft beer. Capital charge is $10 million. Excess return in dollars is 0. NOPAT is 10. So we know that the value of the capital charge, we can use the perpetuity formula, take $10 million a year divided by the 10% cost of capital. We end up with a value of $100 million. That's our invested capital. That fits. All right, excess return in dollars is 0. Take that excess return in dollars and divide it by the cost of capital, and the value of that is 0. And we call that the present value of competitive advantage. Third, let's just now go check our math, and we say that NOPAT, in this case, was 10 million. The value of that NOPAT would be 100 million, 10 million divided, the 10 million annually divided by 10%. And so that's your earnings power value. So what you see is earnings power value is the sum of the invested capital and the present value competitive advantage if the company has that present value. Okay, let's look at energy drink, which we know was not going to be a good investment, but use the same tools. Capital charge is 10 million. Excess return in dollars is -2. NOPAT was 8. Okay, the value of these three layers is the value of the capital charge could always be the same, right? 10 million divided by 10% using that perpetuity valuation formula. And that's our invested capital. The value of the excess returns, now excess returns in dollar are negative, and the value of that is -2 divided by 10%, or -20 million. And that's our present value of competitive advantage, which is negative. This company has a negative competitive advantage. They're earning, the returns on the investment are less than the cost of capital. All right, again, using the perpetuity formula, the value of NOPAT is equal to 80 million, which is 8 million divided, there's a typo. That should be 8 million divided by 10%. All right, and that's the earnings power value. So once again, earnings power value is invested capital plus the present value of competitive advantage, which in this case is negative. So our earnings power value is 80, but our invested capital is 100. All right, last one, Harkabucha. We know this is the interesting investment. Capital charge is 10. Excess return in dollars is 15. NOPAT is equal to 25. The value of the capital charge, same thing. It's going to be the same in all three cases. That's 100 million. That's your invested capital. The value of the excess returns. Now, in this case, we have 15 million in excess returns. So the value of that is 150 million. That's a present value of competitive advantage. And in this case, the business does have a competitive advantage, at least the way we thought about it. You could turn that around and say that without a competitive advantage, the present value of the competitive advantage is overstated. And then the final layer of the value, NOPAT, is 25 million divided by the cost of capital, 250 million. So we know that earnings power value equals invested capital, 100 million. The present value of that competitive advantage, 150 million. Total value is 250 million. So we've been able to use these tools to effectively value not only NOPAT, but to value the components of NOPAT. All right. Now, we've lined them all up. We can see just that invested capital is 100 million in each case. Present value competitive advantage is 0 in craft beer, negative in energy drink, and then a positive 150 in hard kombucha. And then earnings power value is the sum of those two, which is pretty interesting. So will a positive NOPAT attract competition? No, it's excess returns that attract competition. And now we've seen that in 3 different ways. All right, there's NOPAT. There's your capital charge. There's your excess returns. And so we layer those two. So this is the 2 layers of our the beginning of our valuation stack. And you can see that excess returns can be 0 or negative. But if you have positive excess returns, that's going to create extra value. There's an extra value of layer. But it's predicated, dependent on the company being able to hold that those excess returns. So now the reason I want to get to this is because we now see that if those excess returns attract competition, it's the excess returns that get driven away. And the value of the company ultimately will just be the value of its capital charge, which is its invested capital, right? So if that attracts competition, that will get eroded away. So now we can have one more slice at this, which is each of the businesses, will they attract competition? And in the craft beer, not really. You have an invested capital of 100. The value of the business is 100, unlikely. In energy drink, it is the investment's 100 million, and the value of the cash flows will be 80 million. And then finally, yes, hard kombucha is going to attract competition. And that's because you invest 100 million, you have something worth 250 million. But it's those excess returns that are important. Now, what I'm trying to do, and we'll continue this in the next lecture, is build this valuation stack where we just stop and we say the 100 million invested capital, every business should be worth at least its invested capital. And then that next layer is dependent on excess returns, but it also now is setting us up to think about competitive advantage. Because if the company can't hold that blue layer, now we're going to always refer to these as red and blue, and then just to foreshadow, growth will be green. If the company can't hold the blue because it attracts that excess returns attracts competition, then we can't use the perpetuity formula, valuation formula, and all bets are off. But there's one other really important insight, and that is that if the company can't hold its blue value, there's no value to green. So now we're starting to build this up. Red is invested capital. Blue is effectively a function of sustainable competitive advantage. And then green will be growth. And I'm going to go set up green first. And then I'm hoping people realize we're going to go talk about competitive advantage. All right. Thank you very much. See you in the next video.